In American society, homeownership is given special status. It has been viewed as producing a stake in society, good citizenship, and social stability, while leading to personal economic gain. Owning a home is an important component in the American dream. Housing policy has tended to favor homeownership over rental housing. For most consumers, expenditures on housing takes the biggest bite of their paycheck. We saw during the housing bubble from 2000 to 2005 that the rapid value appreciation of houses made homeownership extremely popular. We saw it as an instant road to wealth. Many personal finance advisors recommended buying over renting. Such simplistic advice was dangerous and often misleading. So, the major goal of this issue that we're going to be discussing the next couple of weeks is to develop a framework for evaluating the own versus renting decision. So I would like to kind of go over what we will be doing in the class in these lectures. So first we'll look at the trends of homeownership. Next, we'll look at the types of housing and the advantages and disadvantages of these housing. And then we'll start to assess how much house can we afford. Lastly, we'll go through the costs and benefits of owning and renting. The first analysis we're going to look at is if buying a home is still the best investment. We can see that in 1991, more people, 49%, strongly agreed than in 2011. And overall, people in 1991 had a slightly higher strongly agreed or somewhat agreed with a total of 84% than people in 2011. But this difference was not by much. So for the most part, we can say that Americans still feel that owning a home is the best long-term investment a person can make. In this question, homeowners were asked to assess the value of their home since the start of the recession. 47% said that their home was worth less. 31% said that their home stayed the same. And 17% said that their house was worth more. This shows us that homeowners are very aware of what is happening in the housing market and their property. I actually would like to know what this 17% that experienced an income, what was going on there? Because a lot of people experienced either a decrease in their values or their housing prices staying the same. But this 17%, I would like to know where those homes were and how they were able to have their houses appreciate during the recession. The last question we're going to look at is assessing what current renters want to do in regards to renting or buying. We see that 81% said that they wanted to still buy a house at some point, whereas 17% said that they wanted to continue to rent. So I want you guys to kind of take a minute just to think about what do you think, or why do you think some people or these people felt like renting was better than purchasing a home? And if you're able to join us for the discussion this week, that is something that we'll talk about as well. Here, they asked non-homeowners if they felt homeownership was a goal that they aspired to attaining. Like the other study, most non-homeowners said that they still wanted to own a house. So 72% said that homeownership was something that they aspired to have. But to continue, 64% felt like they were less likely to build wealth by buying a home today than they were 20 years ago. And 43% said that buying a home was no longer a good investment. These results were similar to the last research study that we looked at earlier. These results kind of show us that consumer confidence may have decreased as a result of events that occurred during the housing bubble burst. Consumer Confidence Index. So consumer confidence is measured by the Consumer Confidence Index. And this is just defined as the degree of optimism on the state of the economy that consumers like you and me are expressing through their activities of saving and spending. The CCI is prepared by the Conference Board, and it was first calculated in 1985. That year, the results of the index was arbitrarily set to 100, representing the index's benchmark. So in the most simplistic terms, when the confidence is trending up, consumers spend money, indicating a healthy economy. When confidence is trending down, consumers are saying they're saving more than they're spending, indicating the economy is in trouble. So we've all heard of Fannie Mae and Freddie Mac. So just a little bit of history about these two organizations. So in 1938, the federal government created the Federal National Mortgage Association, also known as Fannie Mae, to create a secondary market in the FHA insured loans. Freddie Mac was created in the 1970s, or in 1970. They are both secondary market institutions, so they do not originate residential mortgages. Instead, they purchase mortgages from banks, thrift institutions, or mortgage companies that originate them. Fannie Mae and Freddie Mac were investor-owned companies that, until 2008, traded their stock on the New York Stock Exchange. The secondary mortgage market is the market for the sale of securities or bonds collateralized by the value of mortgage loans. A mortgage lender or commercial bank or specialized firm will group together many loans from the primary mortgage market and sell group loans known as collateralized mortgage obligations, or CMOs, or mortgage-backed securities, MBSs. Most people have heard of the mortgage-backed securities, to investors such as pension funds, insurance companies, and hedge funds. Collateralized mortgage obligations, again CMOs, is a type of complex debt security that repackages and directs the payments of principals and interest from a collateral pool to different types of maturities of securities. Different types and maturities of securities, thereby meeting investor needs. Mortgage-backed securities, or MBSs, is a type of asset-backed security that is secured by a mortgage or a collection of mortgages. The mortgages are sold to a group of individuals, a government agency or investment bank that scrutinizes or packages the loans together into a security that investors can buy. Mortgage-backed securities were often combined into collateralized debt obligations, which may include other types of debt obligations such as corporate loans. Let's look at a little more closely at more recent history of the homeownerships. In the late 1970s into the early 1980s, mortgage rates increased significantly. The impact caused a slow downturn in home building and a slump in homeownership as people could not afford such high interest rates. One major consequence of this, however, was the creation of alternative mortgage products. The first being the graduated payment mortgage, which we will discuss under issue 6 later on in the semester. So the graduated mortgage, a type of fixed rate mortgage in which the payment increases gradually from an initial low base level to a desired final level. Typically, the payments will grow between 7 to 12% annually from their initial base payment until the full payment is reached. We can see in 2005, interest rates were low again, and around this time, this was the housing bubble era. Homeownership in the 90s was at an all-time high. We can attribute this to 4 main reasons. 1, economic growth. So we saw a growth in the gross national product, or GNP, high employment rates, growth in real income. So those were all things that showed that the economy was great during the 90s. Also, Consumer confidence. So this growth was partially due to a strong consumer confidence. Remember, we talked about this earlier. When the consumer confidence is trending up, it means that people are spending more. Interest rates is the third reason why homeownership was at an all-time high. So interest rates had been declining. They were at a low and had not been seen since the early 1970s. And then finally, community lending initiatives. So we were introduced to a number of government initiatives to help minorities, to help minority homeownership. However, as we know, there were other issues that led to the housing bubble. So just as a comparison, there was an 18% increase in the median sale prices of existing homes between 1970 and 1985. However, between 2000 to 2005, median sale prices of existing homes increased by 42%. We were experiencing what was described as a housing bubble. A bubble in the price of an asset occurs when the market price of the asset is substantially higher than the fundamental economic value of the asset. So according to Carl Case and Robert Schiller, and they wrote an article in the Brookings paper on economic activity in 2003, titled, "Is There a Bubble in the Housing Market?" Expectations of a home's future value can play an important role in housing price bubbles. So a possible cause of the housing price bubble is home buyers and mortgage lenders' unrealistic expectation of future real house price appreciation. The most important factor was the dramatic increase in the supply of mortgage credit. Mortgage debt more than doubled between 2000 and 2007. Along with this increase in supply of mortgage credit came lax underwriting skill standards where borrowers did not have to provide evidence of their income or their assets. Zero equity loans, in essence, no down payment. So there were some mortgages that asked for no down payments. Excessively risky mortgage instruments, such as payment options, adjustable rate mortgages, where the interest rate used to compute the monthly mortgage payment is substantially below the rate used to accrue interest on the outstanding mortgage balance. Fundamentally, there is little argument among economists regarding how much market prices must exceed major economic values to create a bubble. What are you doing? What is that? During the bubble bust, many Americans also experienced their mortgages being underwater or upside down. So the definition of underwater mortgage is a home purchase loan with a higher balance than the free market value of the home. This situation prevents the homeowner from selling the home unless he or she has the cash to pay the loss out of pocket. It also prevents the homeowner from refinancing in most cases. Thus, if the homeowner wants to sell a home because she or he cannot afford the mortgage payment anymore, perhaps because of a job loss, the home will fall into foreclosure unless the borrower is able to renegotiate the loan. So there was a video that discusses this. I'll probably put this in as a link for you guys later. Many people also experience foreclosures. Foreclosure occurs when homeowners with mortgages default on their loans and lenders choose to exercise their collateral claim on their home. This can be due to a number of factors: job loss, unreasonable loan agreement, or a death in the family. Essentially, you default on your loan and your house is basically collateral for your loan. So, you essentially give the bank your home. There are a number of links, or there's there's a link that you can actually look at foreclosure rates, which I will post as well on our Blackboard page. And it's just kind of interesting to look at the different foreclosure rates all over the country and to see what areas have higher or lower foreclosure rates.